Right now, as we watch the tape, Datavault AI Inc., trading under the ticker symbol DVLT, is sitting at $2.16, having slid down by 0.050, representing a decline of 2.28% on the intraday session. When you see a red percentage like that on your screen, particularly with a company carrying the AI suffix in its name, the immediate knee-jerk reaction is to assume the hype cycle is breaking, or that the broader tech sector is dragging the small caps down into the abyss. However, if you are simply looking at that $2 price tag and walking away, you are missing one of the most complex, arguably confusing, and fascinating structural shifts happening in the microcap data space right now. The expectation for most retail traders stumbling upon DVLT is that they have found another generic artificial intelligence play, perhaps something akin to a miniature NVIDIA stock or a speculative software wrapper that will bounce with the next ChatGPT update. They expect a simple story of software sales and user growth. The reality is drastically different and significantly more tangible. What we are actually looking at is not just a software company, but a strange hybrid of a data infrastructure firm, a crypto-adjacent asset holder, and a commodities tracking service, all wrapped into one volatile equity. The drop you are seeing today at $2.16 is not necessarily a sign of business failure, but rather the market trying to digest a massive influx of complexity regarding their balance sheet, specifically involving Bitcoin and warrants, which we need to pick apart piece by piece to understand if this is a discount or a trap. To understand the movement we are seeing today, you have to look beyond the simple buy and sell buttons on your phone. If you open your Robinhood app or check your Fidelity mobile app, you generally see a line chart that smooths out the chaos, but the order book for Datavault AI tells a story of conflict. The volume we are seeing today suggests a tug-of-war between legacy shareholders who are potentially spooked by dilution fears and new entrants who are reading the press releases about Bitcoin acquisitions and mining deals and seeing a massive value disconnect. This isn't the clean, predictable liquidity you get when trading Apple stock or Tesla stock, where institutions dampen the volatility. This is raw price discovery mode, where spreads widen and a market order can sometimes slip a few cents if you aren't careful. It is the type of environment that separates the passive investor, using Schwab Intelligent Portfolios, who just wants steady compounding, from the active trader who is hunting for mispriced assets in the messy corners of the Russell microcap. The decline of roughly 2% today seems small in isolation, but it comes on the heels of massive volatility, where the stock has seen double-digit swings, meaning the 216 level is acting as a critical psychological floor. If it breaks decisively below the $2 mark, the technical damage could invite more short sellers, but if it holds, it validates the recent consolidation range. We need to address the elephant in the room that is likely causing some of this selling pressure despite what look like positive headlines. Recent news confirmed that Datavault closed a second tranche of equity financing with Scilex Holding. On the surface, financing is good. It means cash. Or, in this specific and highly unusual case, it means Bitcoin. Datavault received approximately 1,237 Bitcoin. This is a staggering amount of cryptocurrency for a company of this size to suddenly have on its books. You might think the market would cheer this, sending the stock vertical, but you have to read the fine print regarding the pre-funded warrants. The market is forward-looking, and it hates uncertainty regarding share count. When sophisticated traders on the Interactive Brokers trading platform see the words warrants and dilution, they immediately punch numbers into their calculators to figure out the fully diluted market cap. The fear causing this 2% drop is likely tied to the overhang of potential new shares hitting the market. It is a classic case of good news, asset accumulation, clashing with the mechanical reality of stock supply. Expectation was free money. Reality is more shares. This creates a ceiling on the price until those warrants are absorbed or the market decides the Bitcoin assets are worth more than the dilution risk.
Let's take a step back and look at the business itself, because if you are holding this, you need to know what you own beyond the ticker. Datavault AI is not building a chatbot. They are in the business of valuing data. In the current digital economy, companies have massive amounts of data that sit on their servers like dormant oil reserves. They know it is valuable, but they cannot put it on their balance sheet because there is no standardized way to audit it. Datavault uses its proprietary technology, like the Sumerian platform, to assign value to this data, effectively turning information into a tradable asset class. This is where the comparison to NVIDIA stock or other hardware giants fails. NVIDIA builds the roads. Datavault is trying to be the appraiser for the cars driving on it. They are essentially trying to create a Nasdaq for data, where intellectual property and user data can be tokenized and monetized. This is a massive vision, the kind that sounds fantastic in a pitch deck, but executing it requires changing the way the entire accounting world views intangible assets. That is why the stock is so volatile. You are betting on a paradigm shift, not just a quarterly earnings beat. Furthermore, the company has been aggressively expanding into real-world assets, or RWA. They recently announced a deal with MTB Mining to tokenize minerals, including copper and gold reserves, and even a specific high-value ruby. This is the reality that catches people off guard. You thought you bought a tech stock, and suddenly you're reading about copper mines in Tanzania and gem-quality rubies. This pivot to tokenizing physical assets creates a unique value proposition that you simply can't find in a standard Fidelity mutual fund or a basket of Fidelity ETFs. It makes DVLT a proxy for commodities, crypto, and tech all at once. If the price of copper creates a boom in mining revenue, and Datavault is taking a royalty or a fee on the tokenized trade of that copper, they benefit from the commodities supercycle. If Bitcoin rallies, their balance sheet swells. If the AI sector heats up, their core branding attracts liquidity. It is a three-headed bet. However, this complexity is also a liability. Wall Street likes simple stories. They like to know which box to put a stock in. Is it tech? Is it mining? Is it a crypto holding company? When an analyst at a major firm or a retail investor using SoFi active investing tools can't easily categorize a stock, they often avoid it, leading to lower liquidity and the kind of drift we are seeing today at $2.16. The recent downward pressure is also a reflection of the broader macro environment for microcaps. We are living in a time where interest rates, while potentially peaking, are still high enough to make capital expensive. Speculative companies that rely on future growth rather than current massive cash flows are always the first to be sold when bond yields tick up. When you manage your own money, perhaps through self-investing on a mobile platform, you feel this rotation. You see your safe dividend stocks holding up while your growth plays bleed out. Datavault is caught in this macro tide. Despite their guidance, which we should note is incredibly ambitious, projecting over $200 million in revenue by 2026, the market is in show-me mode. Guidance is cheap. Execution is expensive. The gap between their current revenue and that $200 million figure is the risk premium you are paying for or betting against. If they hit that number, the stock at $2 is a historical footnote of a missed opportunity. If they miss it, the market will punish them severely. This binary outcome is why you don't see this stock as a staple in conservative Fidelity IRAs or low-risk Schwab Intelligent portfolios. It is a venture capital bet that happens to be trading on a public exchange. Let's discuss the technicals again, because the $2.16 level is not random. If you pull up a chart with moving averages, you will see that the stock has been trying to base after its recent explosive move up. When a stock shoots up 40 or 50% in a short window, as DVLT did recently, short-term traders, the flippers, take their profits and leave. This creates a vacuum. The stock has to find a new base of shareholders who are willing to hold for the next leg up. We are currently in that uncomfortable digestion phase. The volume has cooled off from the mania levels, which is healthy, but it also means there is less support if a big seller decides to exit. For those of you watching this on an Interactive Brokers platform with level 2 data, you might see large block orders sitting on the ask, acting as a lid on the price. These are likely the warrant holders or early investors locking in gains. Until that supply is chewed through, the price will struggle to regain its momentum. This is the boring, painful part of trading that investing sites rarely talk about. They focus on the breakout, not the weeks of consolidation that follow. There is also the narrative of the World Boxing Council deal. Datavault is putting its technology into sporting events to capture fan engagement data. This sounds great. Sports are a huge market, but how does it translate to the bottom line? This is the monetization gap that investors are wary of. Collecting data is easy. Getting paid for it is hard. The company claims their ADO technology can track engagement and provide high-value metrics to advertisers and sponsors. If they can prove that their data lead to higher ROI for sponsors, they have a winning product.